Forte Tech Plus. Visit your local Kia dealer today.
Okay, we're going to start with an email here. This is Neil on AGF Management. What does your guest think about AGF? Is this a sector that interests you, or is it sort of, I don't want to say dying, but the peak is long over?
Mm-hmm. So let's look at this a couple of different ways. First of all, let's look at the sector itself. When you're buying the asset management space, you're making an investment in companies that benefit from stronger markets in general. And so if you expect that the market's going to get a lot stronger, say equities, then companies like AGF may benefit. The next thing, of course, you have to do is look at what's happened to their internal performance on their funds to see whether they're getting new money in to manage or whether money's going out the door. And the unfortunate thing is, in AGF's case, is over the last number of years, and 80% of the time, they've been net redemptions. So as an asset management company, you get paid a management fee based on the amount of dollars you're managing, and if that money's going out the door, then it makes it very hard to grow your revenue stream. So, we do think that markets will continue to be cyclical. We're going to get some tactical rallies and tactical declines. We don't think that there is a strong long-term upward trend in place. So if you were going to be in the space, you want to be with the folks that are focused in managing money tactically. And AGF is just sort of not in that camp, so I would avoid the stock. Is there any company in that sector that intrigues you, a CI or anybody else? I think, obvious conflict, we manage 3 funds for CI Financial. But I think in the case of CI, they've been successful in getting some money in the door, and it's a pretty well-managed company. But in general, our view is that equity markets are going to continue to be choppy, and so we wouldn't be making necessarily big bets on asset management companies. Right. We have PDAC on this week, of course, in Toronto, and BNN has had extensive coverage. We're going to talk about a miner right now. We've got Ernie, who's in Victoria. Go ahead, Ernie.
Yeah, good afternoon. I like my question is on Eldorado Gold. And why was there such a high volume today, over 8 million shares? Thank you. Okay, so I can't comment on the volumes today in Eldorado. But I would say the thing that I would point out always is if you're looking at gold as an investment, yes, you want to look at what's going on with the price of gold, which obviously had a tougher time today, but has been reasonable over the last while. The miners, on the other hand, have been underperforming quite dramatically. And it's been one of the weakest performing parts of the market, notwithstanding the fact that they had a great rally through December and January. Overall, there's been really a lack of trend in the group. And I think largely that has to do with concerns around costs and their ability to get the gold out at the right price and make enough money. So we've avoided the group. We don't have any holdings in golds. In fact, we run an ETF portfolio where we've been short the gold miners group, the GDX and the GDXJ. So I don't know what may or may not have happened today, but I do think that there was, there's been quite a lot of money leaving the sector over the last bit, so I'd avoid the stock. And what about gold in general? Where does it stand with this 11-year rally? I think it very much is in limbo or in consolidation right now. Maybe it could trade to $1,600 on the low end. We were recently close to $1,800. We like to buy parts of the market that are seeing net new inflows of capital. We don't see that in this group right now. So I think that at best it's a consolidating group currently. One of the CEOs BNN interviewed today at PDAC was Don Lindsay, the head of Tech Resources. If you missed that, you can watch that on bnn.ca. Right now we'll talk to another Don. He's in Ottawa. He wants to know about Don Lindsay's company. Go ahead, Don.
Yeah, thanks, Mark. David, on the advice of earlier guests, I got out of tech just over 40. And
good for you.
I've been holding the cash, looking for any, re-entry back into it. Could I have your advice on that? Thanks a lot.
Right. Well, if you look at the way that tech is traded, it's representative of a lot of the metal stocks. They all have recouped sort of a half to 2/3 of what was given up from the point where stocks broke down at the end of July. And that to me looks more like a recovery rally or a retracement rally than a beginning of a new trend. Now look at the underlying parts. In general, if you look at the steel industry, the steel stocks are not behaving well. In fact, many of them have taken quite a powdering over the last few days. So certainly not a great indicator for met coal. When you look at some of the other metals, certainly the metal stocks have had a tough time. So, our view is right now there is not enough evidence that extra marginal dollar of demand for commodities is there to push prices a lot higher. So if you think you have moderating growth in Asia and some question as to what's going to go on with recession in Europe, commodities may not be the place to focus, even though, Teck Resources is a very well-managed, well-run business, just might not be in the right space right now. So, in full disclosure, Scott, we're short the stock in our long-short portfolio currently with a few other metal stocks. And I would give this one some space. Long-term moving average, 200-day moving average is still falling. It's been able to recapture the sort of $45 level that I think would give you a sense that things are actually turning higher from here.
And just quickly, you don't think that all the liquidity out there from central banks will float some of these stocks a little bit?
Well, look what's happened over the last 4 months. It certainly has helped. I mean, realistically, in the absence of the liquidity that was pushed into the market in October, we'd be a lot lower, right? So certainly liquidity's had a big impact, but liquidity can only go so far. And at the end of the day, you need demand. So certainly, the liquidity issue has been a positive. But I would say that extra marginal dollar of demand for a lot of these commodities just is really not there.
Right.
And so liquidity can only go so far in floating the boats higher.
Okay, David, we'll take a short break. A reminder that you can send us your questions via Twitter at Market Call. We'll be right back with David Burrows after this.